I'm welcome to the Market Alert for Monday, the 7th of March 2016. And starting off with Friday's market activity, you can see the non-farm payroll figures came out higher than expected. And in fact, let me just get those for you, just one second. And here we see that we had 242 compared to the forecast of 195 and higher than the previous as well. So Yellen's strong labour market continues at some sort of pace there. And this also, interestingly enough, according to Bloomberg, brings back the question of whether they're going to increase interest rates in mid-March, which actually is going to be the week after next when we have the next FOMC meeting. So it'll be interesting to see what she decides to do. Last time she did that, we had the collapse in the markets from January. So who knows what these people will do. And again, it's just a matter of waiting to see how it pans out a week on Wednesday, I think that will be. So the strong labour market continues, and this eventually, I mean, we see the reaction there, the market gapped up and then it came all the way back down, which is really strange. But true to form, they managed to ramp the market up on this news. I'm surprised we didn't have a massive move off this, which sort of made me wonder when we got to this part in the session, because I thought, well, why aren't prices actually moving higher off what we're actually seeing here from these good figures and the opportunity to actually drive prices higher as this market finally run out of steam, where we've seen this bear squeeze and short squeeze over the last few weeks. So again, it's giving that indication. First of all, we had the move to the upside. If we just go through the trades, this produced a 46 point profit. You can see the market moving up there and then eventually driving up. So it drives through the 20 point scalp and then starts to make the rising lows and then finishes off with a 50% below each of the rising lows there. That the bar is narrower than the previous bar, with the market being stopped out here. We then head into the quiet session, and it really was a quiet session because these two trades resulted in a 41 point loss combined. And then in the evening session, which is very unusual because the market moved higher but then reversed and moved all the way back down to where it actually started from the non-farm payroll figures once the market opened at 2:30, which was an 88 point potential profit there. And again, the clue is really this market didn't take off when we had the release or after the release of the non-farm figures, and then the official session the market only managed just over 100, nearly 150 points, 200 points I suppose when we look at it here, and then just run out of steam and prices move lower. So here we've got the market struggling at the 17,000 level. The market is closed just at this level by the looks of things, 16,990. Needs to close above the 17,000, and then we've got the 17,200 level as well. You want to keep an eye on there. News wise for tomorrow, let's have a look at the Forex Factory site. We have to do this in the weekends because it doesn't appear in the software. And there we go. What have we got? So we've got Brainard out and Fisher and Haldane. Blimey, they're wheeling them all out now, aren't they? Just to try and boost the markets. You never used to see these people speak. Nobody knew they existed apart from the bank governor or the chairman or chairperson or chair, whatever they want to be called these days, of the Federal Reserve. Now every man and his dog's allowed out to actually speak to keep this illusion alive. So what have we got then? We've got a Eurogroup meeting all day as well, so no doubt Draghi's going to be giving it something as well. And so a difficult one to call for tomorrow, but I would expect that they'll try and keep this market up just for a bit until we get towards the mid-March, and then after that I think all hell will break loose. And the reason I say that is for two reasons. The implied volatility 1477, you can see this is moved down below the 15% target now, and also on zero hedge they were talking about the volatility index, and here you can see that we're now back to the lows. This is the August lows when we had the last big drop in the market, the flash crash, and you can see the other ones as well where the market spiked in December of 14 and also September. So we are due for a major correction in this market to the downside. They can only keep it going for so long. The lower these figures go, the bigger the correction it will be. So also keep that in mind as well. So at the moment, I think they're going to try and push this market just a little bit more, certainly up until Yellen speaks. And if not, what you'll find they will do is this: they will move the market sharply lower. It may be a case that Yellen doesn't want to be forced into actually increasing interest rates because of what happened last time. And of course, these so-called non-farm and labour market figures have come out better than expected. She now has a dilemma because she promised that she would continue to increase rates if the strong labour market continued to show better than forecast figures, which it is doing at the moment. So it's going to be interesting. It wouldn't be the first time they've actually marked the market down to get out of actually doing something. So it's a very, like I say, a difficult one to call. It may be best just to take long and short trades at the moment, because I can't see them ramping the market with the plunge protection team. They certainly didn't on Friday. That's certainly come to light as the market moved lower 100 points. Again, you have to adapt to what we're actually seeing, and that's sort of the thought process at the moment. They don't want to have to increase rates because we have basically a short covering rally, which, you know, most of the talking heads on the TV are saying that, oh, it's just by the dips, we're off back to the all-time highs. Well, that might be the case. Personally, I don't see it because all of the economic data is just absolutely shocking. And in fact, on Zero Hedge on Friday, by the way, just as we go through this, Sweden begins 5-year countdown until eliminates cash. God help us all, that's all I can say. That will be the start of it. Yeah, this is the thing, the 9 horsemen of US recession. If we just bring these up here, you can see every single economic data apart from this so-called strong labour market is coming out with showing appalling figures and a trend to the downside, recession coming. So like I say, she's painted herself into a corner, and it will be interesting to see what Yellen can actually do to get out of it. So again, I wouldn't surprise me if they mark the market down so that they don't have to, well, there's something that comes out of the woodwork that sends prices moving lower. So yes, we have a strong labour market, but actually we have this problem, just to divert attention away from it and a get out of jail card. But only time will tell, and here we are peddling fiction, as Obama calls it, with these economic charts. You can see there that industrial production now below the line. All of them are below the line. I don't need to go through each one of these, but you can see that we're all showing a recession or coming recession and a global slowdown, but not according to Obama. Anybody that says anything negative about the US economy is peddling fiction, apparently. So I'm quite happy to peddle as much as you want, Obama, because what can't speak can't lie. Your rhetoric is another matter completely. Right, that's it for today. I'll see you in Tuesday's edition. As ever, thanks for watching. I shall see you in the next one.